welcome to Sectors Up Close. I'm Elena Casas. Today we're focusing on US Treasuries and my guest is Amy Kong, CIO of Barrett Asset Management. The US Federal Reserve spent more than a decade buying up government bonds, building up a balance sheet of nearly $9 trillion as it tried to cushion the economy from shocks. It started trying to shrink that pile of Treasury paper in June and aims to reduce the balance sheet by $95 billion a month. Some analysts are concerned about whether the market can absorb that much, or if a lack of liquidity could exacerbate the risks of recession. The Fed itself has calculated that the selling off, known as quantitative tightening, will be equivalent to an extra 2 or 3 extra quarter-point rate rises. Yields on the US 10-year have been following interest rates up since the beginning of the year. You can see they've edged up to 3.95% today, but the 2-year yield has risen far more sharply. As you can see there, it's up from below 1% at the start of the year to 4.42% now. The inversion of these two yields is seen as a classic sign of coming recession, and the curve has been inverted now for months. So, what does that mean for the economy and for bond investors? Let's ask Amy Kong, CIO of Barrett Asset Management. Amy, to start with, can the market absorb the amount of Treasury bonds that the Fed would like to offload? Is there enough liquidity?
Hi, Elena. So far, the liquidity is reasonable. To your point, quantitative tightening is now on high, and that the Fed is actually reducing their buying of bonds. In fact, it's down about 1% on a year-over-year basis, and it's just, again, the tip of the iceberg. Where we're also seeing softening is actually foreign governments are also not buying so much. So to your question, who is buying? Interestingly, we are seeing individuals as well as banking institutions and some state and local governments picking up the slack. And to give you some context, individual buying of treasuries as of September is actually up 50%. Banking institutions up something around 20-25%. So you are seeing a little bit of, again, picking up that stack from other parts of the market.
What then should we be reading into the inversion of this yield curve, which so many analysts have said presages a recession?
Sure. So to your point, the yield curve is inverted, roughly about 40 basis points, and this has been holding steady now for some weeks. Looking back at the tech bubble as well as the great financial crises, it is consistent with the fact that a recession could be looming over the next 12, maybe 15 months. Now, can I pinpoint exactly when a recession hits? It is very difficult to do so because every recession is different. And today, even though we do have some softening parts of the economy, we are still seeing some healthy parts, including the labor market, still adding jobs at this point. So to us, we do think that a recession or the odds of a recession have moved higher, but I think it could probably get pushed out to perhaps, back half of 2023, depending on, again, other parts of the economy, as well as the Fed. The quicker the Fed moves, then the quicker we can get into a recession. And that seems to be the case, considering that CPI data remains very, very high based on last week's report.
Global central banks around the world, of course, are following the Fed in pushing up their rates, and many of them feel that they're forced to as the dollar gets stronger and stronger. Is that going to start putting pressure downwards on the dollar eventually?
Sure. When you look at the yield curves across the UK, Germany, etc., they're not inverted yet. But to your point, because the dollar has been so strong, but more importantly, inflation is a huge issue in those regions as well. We do expect central banks around the world to catch up, if you would, to what the Fed is doing. And so in the coming quarters, we do expect the short end of those global yield curves to move higher. I don't know if it gets inverted. I think there's still some way to go. But what that will likely do is hopefully put a little bit of downward pressure on the US dollar, which has obviously been causing more issues considering how strong it's been. So that's the expectation, is that the central banks, probably with the exception of Japan, is likely to quote unquote catch up to what the Fed is doing.
So how would you advise investors to approach US Treasuries?
Sure. At Barrett, what we are doing is keeping maturities low, meaning we are staying within that 2-year window, to give us a chance to roll over proceeds into probably higher yields, as the Fed is likely to remain aggressive going into 2023, considering how again, strong the CPI data number was last week. It is very likely that the Fed will have no choice but to continue to stay aggressive going into the next couple of rate hikes. And so for us, keeping maturities on the short end, again, gives us the opportunity to capture higher yields as those maturities roll over.
Well, thanks so much for joining us, Amy Kong, CIO of Barrett Asset Management. Well, that's our look at the Treasury market. I'm Elena Casas, and this is Reuters.